Okay, let's continue the intangible asset simulation, including the franchise accounting. In the last video clip, we finished this franchise the accounting. Then the second, a corporation incurred 65,000 of experimental and development costs. I think that is the R&D expense, in its laboratory to develop a patent that was granted on January 2nd, 2004. And the legal fees and other costs associated with the registration of the patent totaled I think what is that? Okay, 13,600. A corporation estimates that the useful life of the patent will be 8 years. Generalized the entity of the cost and amortization. Okay. January 1st, now we should recognize R&D expense, surely, because that is the cost of experimental and development cost in the laboratory. So it's unsure that this is gonna be capitalized. So we just report R&D expense. R&D expense, how much is? Yeah, 65,000, and cash out 55,000. Okay. And then patent capitalized. The legal fees. Now the legal fees and the success, if it is successfully defended or not. Okay, these legal fees are the costs associated with registration. Oh, that is the registration fee. Okay, registration fee should be definitely capitalized as the patent. So patent 13,600. 13,600 should be capitalized. Cash out 13,000. Then a patent amortized by step line. Okay, now is very easy. How long years was that? 8 years. So here we put the amortization expense. The 13,600 divided by 8 years, so 1,700, and accumulated amortization. Once we use it, so we should allocate the cost of this $13,000 patent. So we put the patent here. Starting from the R&D expense. Where is R&D expense? Okay, there we go. The R&D expense. And then cash out. Another cash out. And then patent. The capitalized patent. And then cash out. Then amortization for the patent, accumulated, and then amortization expense we have to add up, but it's minus because that is an expense. So now you see we balanced out total asset and total liability. Next, trademark was purchased from S Corporation for $32,000 on January 1st, 2004. Expenditures for now the successful litigation example. In defense of the trademark totaling $8,160 were paid on July 1st, 2004. A corporation estimates that the useful life of the trademark will be 20 years from the date of acquisition without a renewal. That has the useful life. Amortization expense, okay. Legal cost now the capitalized. Then we add this the legal cost trademark. Trademark how much? 32,000. That is 32,000. And then cash out 32,000. Then legal costs now capitalized. That is the now should be added. Trademark. That is the legal cost, but should be capitalized because it is successfully defended. So how much is that? 8,160. then cash out the same way. And then trademark, the amortized. How much is the trademark amortized? How do you calculate it? Okay, let's put the first one, each one. I'm just to use this, to be fast. To say the name of account. Oh. Here, how do you calculate it? First, $32,000. $32,000 the trademark should be amortized by 20 years plus now this 8,160 should be amortized how long years? 19 years and 19 and a half years. Why? Because the legal cost capitalized, the time the legal cost capitalized was the July 1st. So the useful life of this legal cost is not 20 years, 19 years and half, 19 and a half years, right? And then how long month for the December 31 year 4, 6 months out of 12 months. So $1,809 is the amortization expense for the trademark. So accumulate amortization exactly the same. Now let's put this to trademark and then cash out. One more time, cash out and cash out here. And then amortization expense, additional amortization expense, then accumulated amortization on the balance sheet, so that would balance it out. Okay. Finally, on December 30, 2004, A Corporation purchased the net asset of Kohl's company for $300,000. That is the consideration. That is the consideration. Actual payment on the fair value of the company. The fair value of Kohl's net asset is $240,000. That is easy because you can calculate. The difference between two is the goodwill, the $60,000. For example, here we have the net asset of the acquired company. The fair value AR 100, inventory 40, PP&E 120, and accounts payable to $20,000 assumed. That there has been no indication of impairment for all intangible assets. Okay, let's put this AR. The AR assumed is $100,000, the fair value, and then inventory increased from this acquisition is $40,000, and then the PP&E. Let me just shows. Then the PP&E from this acquisition acquired is $120,000. Then accounts payable assumed is $20,000. Then cash paid. How much cash paid? $300,000. That is the consideration. Then, as you can see, that definitely here the sum of this, the credit is greater than the sum of the debit. So I'm gonna just calculate goodwill created by this acquisition is the sum of these two minus sum of this asset. So the goodwill is $60,000, or you can just calculate $300,000 minus $240,000, the fair value of net asset. You can get the same result. Then let's record AR $100,000. Here go. AR $100,000 and inventory $40,000. Inventory $40,000. Then PP&E, we don't have the accumulated depreciation because the acquisition incurred at December 31st, year 4. Then PP&E, then the goodwill, and accounts payable to $20,000. And then cash out, finally, $300,000 for the acquisition of big company. So we balanced out between the total asset and total liability and equity, and we finished creating the income statement for the year ended December 31st, year 4. Okay, see you in the next video clip. Bye-bye.